Well, I don't even like Chipotle. Every time I eat it, I get a belly bump.
Why did you bring it up then?
Because I was talking about the keto style burnt cheese tortilla that you can get tacos in at Rubio's. And you were supposed to buy me lunch because you used
I don't
AI
like
to
Rubio's.
prepare our show.
I use AI to prepare almost everything now. It's fast. It's a good, fast way to start something.
Alex, speaking of AI, we're on the show. We're recording live, Financial Detox, and we're going to talk about AI. You'd like the sneaky record? I just brought it up on you. All three of our listeners are going to be like, do they realize they're being recorded until I say that?
It started with the lunchtime conversation, but I think it's important to
you owe me lunch. That's why it came up.
Why? Why do I? You sound like my son. I didn't bet you anything. Like, what is happening here?
I just feel like it's time for you to buy me lunch. Welcome to the show. It's Financial Detox. I'm Jason Labrum. You can always connect with us at financialdetox.com. You can send an email to jason@financialdetox.com. It's easy to get a hold of us. You can also call us, but who calls people nowadays? I don't know. It's nice. Some people like phone calls. 877-707-8889. We're talking about AI. Can you believe I remembered that number? I haven't said it in like 10 shows.
You should call it and make sure it still works too.
I don't even know if it works. Call us and see if our number works. We're talking about AI. We use it all the time. So as a wealth management firm, what I'm concerned about though, Alex, exposing vulnerability here, is I'm concerned that maybe I'm using it like the classic old guy who uses it as an advanced search. But I think where you're probably a little ahead of me on it, but it's really about how you create your prompts and how you work with it. It's not, hey, I ask one question, I get one answer. It's I ask a question, it sets the stage for a conversation. And then as I develop that conversation, i.e. as I prompt it to give me more and better data, because I found multiple times it gives me actually incorrect data, like convincingly incorrect data. And then I say, hey, what are you doing? That's incorrect. I know that's incorrect. Why don't you? And then it'll actually apologize and say, I'm so sorry. You're right. How should I? And then it'll say, no, I looked further into this. And have you found that? Is that happening to you too?
Well, yes. And what I love to do in life is when I'm not sure about something, I ask questions of people that I trust. So it's trusted sources. And so this actually came up in our client advisory board meeting a little over a month ago, where we invited in our I would say arguably our top clients, or many of our top clients at least, not just because they have a lot of worth and they've been with us a long time and have a lot of trust, but because we respect their opinions on their different areas of expertise. Like how did they make their money, the values that they have, their families, all the different things that make them really special to us. We asked them, one question we asked them on this point was, when you're not coming to IDA for your advice on your investments in financial planning and taxes and all that, where do you go and why? Right. And they answered the question like this, all of them in different words. They all were very honest. And they said, well, some people go to Google, some people go to social media platforms like Instagram or TikTok or Twitter. Well, what's it called? X, sorry. They said something that was even more interesting. They also had trusted human being groups, like trusted friends or trusted industry groups, or even some of them had lobbying groups because they were in big companies that actually have lobbying groups. So they're kind of on the inside track for certain topics, certain information. And then here's the most important part. They compared all the data points to each other. They would say cross compare like 2, 3, 4 different sources into one truth. That's the problem with fact. Fact can be tricky. Like what is true, what is false? You go into ChatGPT and you ask it a question. It's gathering all the same information you could on Google really fast, but you still have to compare it to something. I think you can't just say that's the truth.
But so you're not taking the time to go compare that to and call people and ask people for their opinion on one quick search. So what do you compare?
I kind of am. And that's what these we're going to get into these companies that we're going to talk about, the AI boom and the wealth boom.
It's a boom. We have a legitimate boom going on.
I think I am. I think, and then there's people much smarter than me that have a lot more experience in their businesses, maybe, that are taking whatever AI tells you, whether it's Chat or Claude or Gronk or whatever, And it's comparing it to first what they think is true, their own experiences. They're going to other human beings and comparing that. Before you make a decision, it's important to slow down and think about what you're doing. But what it's doing is it's speeding up the sharing of information. It's just accelerating the pace.
No doubt. So let's talk about it. I mean, when we look at what's going on right now in our world, because we're financial detox, we're helping you make better investment decisions with your money, helping you avoid the toxic advice and toxic decisions that so many people have. So we're always looking at it through kind of a risk lens. How do we protect what you've created for your family? And how do we give you access to investments and information that maybe you otherwise wouldn't have? But when we go take a look at a couple things that are going on, we have Nvidia right now that has become $3.8 trillion valuation. It has become the largest company in the world, driven by, pump that up a little bit for y'all, but that is driven by AI. AI needs chips, they need data storage, they need power and energy, which is a remarkable transformation. I mean, there is a revolution happening here within this. Wouldn't you say, Alex?
I would. And ironically, I believe if I'm looking at this correctly, it's currently at its all-time high today. Is that right? Is this real time? So
yes,
52-week high was 154. Today's at 155.88. So it's the highest it's ever been today. Literally.
Today.
Good timing.
Today. And then you have other companies that are interesting too. And while we keep that up here, you look at, for example, CoreWeave was a company that went public in March of this year at $40 a share. Today, it's up 298% in that short amount of time. It's just unprecedented, trading at $158 from a $40
AI infrastructure. That's what they do.
You go. Okay. Cloud infrastructure and AI. Advanced Energy has started making interesting moves. So there's a lot of companies that I think what's happening too is if you look at the Magnificent Seven, and those were the big 7 companies, Nvidia is one of those, Google and Amazon, and you're looking at what's happening there. It's kind of flat for the year, right? It actually has lagged, but I think that's because the depth or advancement of AI is now trickling down into all the other companies around it. You posted a great article, Alex, that we were going to look at today. I'm not sure if I have that exact one, but talking
2 or 3 actually.
Yeah. But talking about looking at IBM and how it's starting to behave, very involved in AI and data storage. And then you look at even companies like Exxon and Chevron, you go, wait, that's an energy company, that's an oil company, but you cannot have AI without a lot of energy infrastructure. You need energy infrastructure. Coincidentally, infrastructure as an asset class, privately, you can generally invest in as well, which is a phenomenal asset class that provides great diversification to your portfolio. But IBM has done, up 73% in the last year.
Which is a company that I used to hear about in the news a lot, right? And I don't think I personally, and my father worked there, by the way, for a long time. I have not heard IBM in the news for like years, right? They're quietly doing something, I guess, off my radar.
Well, they're very involved in a lot of advancements of technology. Technology, by the way, cool statistic I picked up. Technology has become basically 15% of the GDP. The global GDP. It was 2. It's 15% now. I mean, technology has become, and I think in technology, you can put AI, you can put data storage, you can put all these things, right? It has become a significant part of this. We had industrial revolutions, we've had technological revolutions, and I think we're really in a second phase of another technological revolution coming off of the internet.
Think back to 2000, 2001, Jason. You remember those years really well. That's around when you were starting out in this business, right?
Those were painful years, 2000. And when I started bringing on clients as an advisor, and we had 3 tough years in a row.
What is this? Does this right now remind you of those times in any way, shape, or form?
It does a bit. It's a good question. I know it's a leading question. You're trying to trick me here. Yeah, you're definitely trying to trick me.
But in all seriousness, though, isn't it like too good to be true, this wealth boom that's associated with this new version of technology?
I don't know. If you look at the internet wealth boom, it shifts. I think what you have to do is be willing to look at where am I wrong or where is there new information, and you have to be willing to pivot. Now, that doesn't mean change your investment philosophy, because we're really staunch when it comes to have an investment philosophy, have one investment philosophy. But that investment philosophy may be to reevaluate the global macroeconomic environment and make pivots. Because if you look at the 2000, this is a great point. You look at the 2000, 2001, 2002 timeframe, right? When the internet bubble burst, and people will say, I don't invest in stocks, or I don't like stocks because I lost all my money during that time. Well, first of all, you didn't lose all your money unless it went down and you sold it and got out of the market. If you stayed in the market and you stayed diversified and you rebalanced your portfolio on a regular basis, you didn't lose all your money. In fact, you just went from owning things like AOL and maybe Yahoo and Munder Net Fund, and who were up 210% and then down 90%, but you pivoted into different types of investments. And not long after, you are investing in Microsoft, and you have, maybe you had Microsoft through all that, but you have Amazon and you have Google and you have all these other companies that were just the next evolution of that cleansing. We're going to have a cleansing in AI, no doubt. I think that is just like when I was early in my career and trying to figure out where to put money. And man, if you stuck to the old school and you weren't willing to think forward, and you didn't have a process and a philosophy to evaluate companies based upon really fundamental characteristics, and we're big on this. So we like to buy companies. We love to buy stocks. A lot of times we buy them through ETFs. We also buy them individually, but we do it in a way that we're looking for stocks that have fundamental characteristics that are attractive, that create the comprehensive portfolio we want. An example would be a company that has really high earnings growth. That would be Nvidia, or that would be AEIS, right? Was it AEIS? Which one had 130% growth last quarter?
112, close. You almost, that was a good recall.
112% growth in a quarter. So a company that has really high, consistent growth, that can be a fundamental characteristic that we're attracted to. But then we're also want to look at the book to market value. Is it reasonably priced? Is the earnings sustainable? Have they done that for a while? Stuff like that.
I think you're hitting on, by the way, the three takeaways we want listeners to have this show are, there's three hidden risks that we see right now. There's probably more than that. We're not going to get into all of them today, but there's at least three hidden risks in what's happening with this AI wealth boom that do remind me at least of the dot-com bubble burst, right? And one of them is concentration in this particular sector. Right. So sector risk is a real thing. And you already touched on one of the ways that sector risk can be mitigated, which is a prudent rebalancing methodology that uses not just sectors, but fundamentals or even asset classes. Right.
Yes. I mean, you've got to stay on top of it, right? You can't just buy something and hold it and hope it works forever. It doesn't really work.
Even owning the three major indices and thinking that and rebalancing within those, which most people don't even do. But like if you own the Dow, the NASDAQ, and the S&P, you're like, okay, I'm good, right? I got 630 stocks. They're all the big names. They're all the names we're talking about for the most part. There's a bunch of AI in there. And then maybe I'll shift between the three of them every once in a while, like good to go, right?
Yeah, probably not. What's happened, the scary part is if you look at the concentration in the S&P 500, and so many people have done a great job, I think, by saying, look, I'm not going to try and pick the hot one stock that works. Instead, I'm going to buy the S&P 500. It's a diversified portfolio of U.S. large cap stocks. It is diversified. But right now, is it? Because 37%, I think, or 32% of the S&P 500 is concentrated in 10 positions.
Yeah.
So are you really diversified? And those are 10 positions that have done really well. They've gone up a lot in value. I'm not saying they're bad positions. Nvidia, look, is a phenomenal position. It's one of our best performers. We own Nvidia across the board. For any of our clients that own equity, that have Nvidia in their portfolio. But I still think you have to continue to look at that portfolio and how it's positioned and make sure you don't get over concentrated in any other couple. Now, look, diversification creates safety and security. Concentration creates risk and volatility. But concentration can also make you really wealthy. So that's a game you got to decide. Am I willing to pay? Am I willing to concentrate in something and hope that it works, and maybe it does? Or do I want to take a maybe slower, but certainly higher probability of achieving a certain goal? I'm just willing to wait a little bit longer. Most of the time we choose that.
I think pursuant to our company purpose is to steward true financial peace of mind. It comes back to the latter, which is we're trying to give people that peace of mind through the way that we make decisions on how to invest money. And so it tends not to ever come back to let's make a bet on a sector for a little while and see how it turns out. Right.
Right. I think where a lot of people, and I think one of your articles was talking about this, Alex, you had a Crescent article who is a wealth management capital firm. Then they talked about the different ways that people get exposure to different asset classes in AI. And I think there's a lot of AI companies and companies that are driving this that are not even publicly traded. And those are the next Nvidia, right? How do I get the next Nvidia? Not the Nvidia that's now at an all-time high and the largest company in the world, but how do I get the company that's a small company that's going to grow to be even a tenth the size of Nvidia and I make 3,000%? And I think you have to look outside of public markets and start considering even venture capital, which is early stage private equity. Those are really young, sometimes pre-revenue type companies. Definitely more risky. You look at venture capital funds that buy 20 companies, and there's a good chance that 5 of those are just they're gone. They're going to go broke. And maybe it's 10 or maybe it's 15, but if they have 5 that work, those 5 become unbelievably large successes and you make a lot of money. Then you can go into straight up private equity, which could be a buyout type of deal where you have founders that sell a company later to a private equity firm that brings in capital and brings in some intellectual capital and physical capital, and they grow the company exponentially. You have later stage, which maybe are secondaries where you're getting a second private equity coming in, taking out the first. So there's lots of phases in a company's lifespan, but there's a really good opportunities to do that. And now there's a fund structure called an interval fund, which has been around for a long time, but it's being reinvented. And that interval fund gives investors the opportunity to not have to do what you traditionally had to do to get access to these private markets and these unique investment opportunities. You had to typically make a 10-year capital commitment. You had to commit all this capital, and then they only draw down a little bit at a time, but you had to keep all the capital liquid and ready to go, waiting for a call for that money. So you had not only a terrible J curve, which is the downturn of initially investing that money in the businesses, but you had money on the sidelines. So it's a really hard way to do it unless you had just enormous amounts of money. Nowadays, you can put that money to work tomorrow and it's going for $50,000 or $25,000, and sometimes even $1,000 minimums, like crazy low. You can own a diversified portfolio of private companies focused in particular technologies or whatnot.
You're leading up to the next hidden risk, by the way, because I think there's plenty of people. I think it's a Hamilton Lane source that we have here, $2 trillion in assets that are moving over to private credit and others. And so if there's a lot of people already onto this, right? And so that also creates a lot of risk as well, meaning that it's so important to understand how to think about if you have an overall portfolio of, $10 million. How much should be in private investments versus liquid, other types of investments that have more liquidity for your own needs? And what if this is not going to happen? I'm not saying it's going to happen, at least. What if something happens where the ones you have do close those gates, those interval funds, close those gates for some reason? What does that mean for your situation, your financial plan? Like, this is a risk. People, I don't know if they've thought through it. Like, hey, everyone's doing it. I want to do it. Let's get in. Let's move all our money over there. It's doing better than public markets. Okay, but then what are the downsides? What are the potential risks? I'm not saying don't do it. I'm just saying make sure you understand what those are and understand how it relates to your personal situation, right?
You bring up a really good example, and we'll come to a wrap here on this because we could talk about this for probably 2 or 3 days straight. I think we need to get some other guests on the show, some people who are involved, because I think we got to bring into the equation stablecoins and what's happening with stablecoins. A recent IPOs up dramatic. Good friend of mine, Tom, very active in the space. They're doing lending internationally, intra-country lending and stablecoins. It's basically type of cryptocurrency, but it's marked to the US dollar. So you should be able to redeem it dollar for dollar, 1-to-1 on the US dollar. Unbelievably interesting banking options that are going to come out of stablecoin, and particularly even the US government creating a stable coin, which is tied to the US Treasury, and where you could literally buy the stable coin and have access to treasuries. You don't have to go through a broker, a securities company. A very interesting way to earn interest in a stable coin. So that's a whole nother show that we'll just probably try and unpack straight up stable coins. But you made me think about when you talk about risks, because that's what we're doing here. This is a really exciting time. There's no question. You got to be involved in it. If you want to grow your net worth and you want to grow your investment portfolio, this is a great time. There's opportunities. There are things happening right now that just don't happen on a regular basis. This is a revolution. This is a unique experience in time, similar to when the internet started. And if you go back to, the steel revolution and the industrial revolution, and there's certain times where when I talk to some of the multi-generational family offices and just, multi-billion dollar families, there's always a story tied to a revolution. And I don't mean revolution as in there's going to be a revolution, uprising of humans, but a revolution of, maybe I'm using the wrong word, but a full introduction or change of technology or change of the way things are done. Yeah. Every time. And you look to the Rockefellers and you look to, I can't name some names, but several other people I know, it was because their dad or their grandpa was involved in that industrial revolution, or they started a company like an Amazon, or they were early investor in Amazon, or they were early investor in whatever. And now it's becoming this AI. And I think also tied into that is going to be stablecoin, might be another one, and the Bitcoin, which we knew was going to be huge, Bitcoin, and the technology behind Bitcoin. We just didn't know how to invest in it. But I think it's kind of starting to consolidate around stablecoins is where, and even Bitcoin, the volatility of Bitcoin is a store of value, quote unquote. I'm using air quotes if you're just listening, but the volatility has come down dramatically. It's almost starting to look like potentially an institutional asset class. Very interesting. But the last thing I want to say on the risk there is liquidity matters, right? And understanding your liquidity, because some of these investments, if they're going to be volatile, you don't want to sell them when they're down if you believe in them long term. And particularly in alternative investments, when people bought, for example, TIPWX, which was a real estate total income fund, and then interest rates went up and that fund did not do that well. It actually did very well compared to all other real estate funds, but compared to the other parts of the market, it didn't do well. And I was on the chat boards from like Yahoo Finance and different places looking at really novice, inexperienced people who bought that, even through their bank financial advisor, who the bank financial advisor certainly didn't understand the illiquidity provisions, and they sold it to the client. And the client had no idea that their fund is only required to have 5% available every quarter, and they can close the gates after that. And so if there's 20% of the fund redeeming, you may only get 20% of your money back if you try to redeem it. And that may go on for years and years and years. And so the people are like, I hate this investment. They're thieves. They're stealing my money. They won't get it back. And I'm like on the chat board going, did you not read? Didn't your advisor tell you? Didn't you read the prospectus? Nobody's stealing your money. Nobody's holding your money captive. That's what you invested in. So to your point, long story long, you really do need to know what you're buying. I mean, you have to know what you're buying, or you have to have a lot of confidence that your advisor is giving you the right information and they absolutely know what they're buying. And if anybody tells you there's no risk in something, or there's no volatility, or they're not explaining the potential negatives, then that's a big red flag there in and of itself. That's probably toxic advice.
It's a good takeaway for people. I think it's happening. The AI wealth boom is happening. Just, ask questions, learn, continue to learn, check your sources, right? Check them against each other as well.
Largest company in the world. We have a new largest company in the world, Nvidia, because of the AI wealth boom. And there are so many ancillary benefactors to that it's a great time to review your portfolio. It's a great time to make sure you have really good exposures to your portfolio. And there is more cash in money market and cash on the sidelines now than ever. And it's not a great time to have cash sitting on the sideline when there's an entire wealth boom and a revolution happening, technological revolution with AI. Having a bunch of cash sitting around in the rearview mirror, that's going to look like a pretty bad decision. So we're happy to help you avoid toxic advice, make better decisions with your money, protect your wealth, and get access to investments you might not otherwise have. It's Financial Detox. Alex, thanks for being here today. It's a quick record on a unique software day. We didn't have Shayna and Brian in the background. Kind of sucks not having them.
I missed them. Yeah.
Yeah. But they were unable to join us today. So we went here. Hopefully this works out well for you, our listeners. We'd love it if you give us a like, a subscribe. If we get 2 or 3 subscribers, that should double our total subscribership. So that'd be awesome.
I think we're actually closer to 2,000, but it's close. We're getting there.
Are there any Americans on there?
Yes. Plenty.
All right. This is very good. Well, thanks for tuning in. As always, I'm Jason, your host, Financial Detox with Alex Klingensmith, and we look forward to catching you on the next show. Cheers.